Right, no fluff, no messing about. Welcome to the Big Short Club. I'm Chris, the crypto degenerate.
And I'm Morgan, the one who actually understands how markets work.
Mm-hmm.
Forex, stocks, the proper stuff.
Oi, cheeky. Today we're diving into the proper stuff then. CMT level 1, but make it street. We're talking futures contracts. Morgan, mate, this is your world. Break it down for the people. What even is a futures contract?
Right.
Don't say it's complicated.
It's not. It's dead simple. Think of it like pre-ordering a PS6. You go to the shop, put down a 50 quid deposit,
Okay.
and they guarantee you get the console for, say, £600 on release day in 6 months. That's a futures contract. You've locked in the price for a future date.
A pre-order, got it, but we're not talking about games consoles.
We're talking about barrels of oil, gold bars, the S&P 500 index, currencies, even your precious Bitcoin. The key is these contracts are standardized. A contract for oil on the CME exchange is always for 1,000 barrels.
Right.
Everyone trades the exact same thing. No dodgy fine print.
Standardized. See, that sounds a bit, boring. In crypto, our perpetual futures are the Wild West.
Yeah.
24/7, 125x leverage on finance. Let's have it.
Yeah, and that's why half your mates get liquidated before they finish their morning coffee. The boring part is what makes it a multi-trillion-dollar market professionals use. The most important concept you need to get your head around is margin.
Now you're talking my language. Leverage and margin. Go on.
With futures, you don't pay the full whack. To control that 1,000-barrel oil contract worth maybe 100 grand,
Okay.
you don't need 100K. You just put down a deposit, the initial margin, maybe 5,000 pounds. It's a good faith deposit to show you're serious.
Okay, so it's pure leverage. You're controlling a massive position with a tiny bit of capital. Love it.
But here's the bit that catches people out. Mark to market. At the end of every single trading day, the exchange looks at your position. If the price of oil went up and you're long,
Yeah.
they put your profits directly into your account, cash, that day.
Nice. Instant profit.
But if the price went down, they take the loss out of your account instantly. And if your account balance drops below a certain level, the maintenance margin,
Uh-oh.
they get a margin call. The broker phones you up screaming, "Give me more money or I'm closing your position."
The call of doom. I know it well. So this is all interesting mechanics, but the title of this pod is How Do Futures Influence Price Trends?
Right.
Connect the dots for us, Professor.
This is where it gets juicy. The futures market is a massive window into the brain of the market. And the two magic words you need to know are contango and backwardation.
Sounds like a dodgy detective duo from the 70s. Contango and backwardation on the case.
Shut up and listen. You might learn something. Contango is the normal state of affairs. It's when the futures price for, say, December is higher than the price to buy it today, the spot price.
Okay.
It implies the market thinks the price will be higher in the future, or it accounts for the costs of storing the asset, the cost of carry.
Okay, so contango equals market's a bit bullish or just normal. What's the other one? What's it?
Backwardation. And this is the one that should make every technician sit up and pay attention. Backwardation is when the futures price is lower than the spot price. The market is paying a premium to have the asset right now.
Hold on. So if a barrel of oil today is $85, but the futures contract for 3 months from now is $80, what's that telling me?
It's telling you there's a massive demand for oil today. A supply squeeze. Refineries are desperate for it.
Wow.
They're willing to pay more to have it now than wait. It's a giant flashing neon sign that says high demand, low supply.
Right.
And what happens to price when demand outstrips supply?
It goes parabolic. It rockets up. Okay, I'm with you. So just by comparing the futures price to the spot price,
Yeah.
you get a massive clue about the underlying supply and demand dynamics. That's powerful.
It's a leading indicator. The futures curve is basically a forecast from the biggest, most informed players in the world. When you see backwardation in a commodity,
Yep.
the futures curve is basically a forecast from the biggest, most informed players in the world. When you see backwardation in a commodity,
Yep.
you should be looking for a long entry on your charts. The fundamentals are screaming buy.
Let's bring this to my world, Bitcoin. The CME launched Bitcoin futures in December 2017. What happened to the price of Bitcoin like the next day?
It topped. Absolutely topped out at 20K.
Right.
And then fell off a cliff for a year.
And why? Everyone was so hyped saying the institutions are here.
The institutions were here, and they wanted to short the hell out of your bubble. Before the CME contract, it was hard for a big fund to short Bitcoin. It was a messy, unregulated nightmare.
Yeah.
The futures contract gave them a clean, regulated, cash-settled way to bet against it. They did, and the price collapsed. That's influence.
So the futures market didn't just predict the trend, it created the trend by enabling a whole new class of sellers. Mad.
Exactly.
This is also why crypto traders are obsessed with the CME gap. Explain that one. It's your world.
The CME closes for the weekend, but crypto markets don't. So Bitcoin can pump or dump all weekend. When the CME reopens on Sunday evening London time, the futures price will gap up or down to catch up to the 24/7 spot price.
Okay.
And there's this massive belief in the crypto space that those gaps almost always get filled. The price will eventually return to close that gap.
It becomes a self-fulfilling prophecy. Traders see the gap on the chart and place their trades based on it, which in turn causes the price to move towards the gap.
Exactly.
So the existence of this Monday to Friday futures product directly influences trading strategies and price action in a 24/7 market.
Right.
It's wild. Okay, so we've got contango and backwardation. What other tools can we steal from the futures world? You mentioned them in the office the other day.
Right.
Open interest. This is a big one. Open interest, or OI, is the total number of outstanding futures contracts that haven't been settled.
Right.
So it's the total number of open, long, and short positions?
Precisely. Now, you read this alongside price.
Okay.
It gives you a conviction meter for a trend.
Okay, scenario one, price is trending up and open interest is also trending up. What does that tell me?
New people are jumping in the pool. Fresh money is coming in to bet on the price going higher.
Yeah, that sounds mega bullish. It's a healthy, strong trend.
Spot on. New longs are initiating positions, fueling the move. Now, scenario two, price is still trending up,
Okay.
but open interest is flat or falling.
Ooh, so the price is rising, but the number of players is shrinking. That means the move is being driven by shorts getting squeezed and being forced to close their positions,
Exactly.
not by new buyers entering them. It's a hollow trend. The fuel's running out.
I'm impressed. You're a better student than I thought. That's a massive warning sign. It tells you the trend is mature, it's getting tired,
Right.
and it's vulnerable to a reversal. You should be thinking about taking profits, not adding to your long.
So let me complete the matrix. 1, price up, OI up, strong trend, new money's coming in, bullish. 2, price up, OI down, weak trend, shorts are covering, bearish warning. 3, price down, OI up, strong trend, new money is coming in to short it, bearish. 4, price down, OI down, weak trend, longs are capitulating and closing out, bullish warning, potential bottoming.
That's the framework. It's not a perfect crystal ball, but it's an incredibly powerful layer of analysis that most retail traders completely ignore. They're just looking at lines on a chart. You're looking at the flow of money behind the lines.
This is proper alpha. It's like having X-ray vision on the market.
You see not just what the price is, but why it is what it is.
Now you're getting it. It's the difference between being a passenger
Yeah.
and looking under the bonnet to see how the engine works. Let's talk about the two tribes of the futures world. You mentioned them in the office the other day.
Right.
The hedgers and the speculators.
Right. Two completely different animals. Hedgers are using futures to manage real-world business risk. They're not trying to make a profit from the trade itself.
Okay.
Think of a massive airline like British Airways. They know they'll need to buy millions of gallons of jet fuel over the next year. They're terrified the price of oil will skyrocket.
So what do?